Hi everyone, Jeff Yasteen here. Make sure to subscribe to us on YouTube, follow me on Facebook and on Twitter, and don't forget to ask a question or leave a comment in the comment section below, and I'll be sure to get back to you on that. There's a question here that used to perplex me for years, and I know from the emails I get from many of you, you also have questions about the subject. The question is, how much should I buy? How many shares of an individual stock should I purchase? Now, when I started years ago as an investor, I had trouble answering this question as well. Then I kind of came to a realization. There's no small number of people and computer programs out there telling us what stocks we should buy and when we should buy them. But in my years as an investor, as a trader, as a former financial reporter who's interviewed lots of hedge fund guys and mutual fund managers, I can't remember any of them ever talking about how much we should buy. So I'm going to show you in this video a 6-step sort of back of the envelope method that I use. There's nothing magical about it. If you choose bad stocks or you happen to start investing as a bear market or correction sneaks up, it won't prevent you from losing money, but it will help you keep an overall eye on your risk, and it will help you see that risk better and give you a better chance of avoiding the biggest threat for most new investors and many of us older investors as well, which is blowing up your investment account by taking risks that are too large before you've had a chance to develop experience and knowledge that you need to succeed in the stock market. So the steps I'm outlining here will give you an answer to that painful question that we all have to face when we start to invest or speculate, which is, how much will I lose if I'm wrong? So here are the steps. Step 1, figure out your portfolio's total value. For instance, let's say you're just starting out. You decide to start an investment account with $10,000. It could be 1,000, it could be 1,000,000. It doesn't really matter. The math works the same way. You can still lose a large sum of money just as quickly as a small one. Step 2 is figure out what you're comfortable with your percentage risk per trade. Now, my personal default number is 1%. I figure I can be wrong 10 times in a row and only be down 10% on my overall portfolio. For some people, it might be a fraction of that or a larger percentage number. So $10,000 portfolio, 1% of that is $100. So like I said, how many times can I be wrong in a row without blowing up my account beyond repair? Now, I won't bore you with the simple math on this part, but here's how I think about my portfolio's value relative to risk. If I experience through a series of bad trades a 10% loss in my portfolio, then I need 12% in gains to get back to break even. With a 20% loss, it's 25% in gains to get back to break even. With a 30% loss, it's a 42% gain to get back to break even. With a 40% loss, I need 66% in gains to get back to break even. So this is where most of us go wrong, especially again when you're new to investing and speculating. We tend to be overconfident. We buy too much relative to the size of our portfolios. And if those trades happen to work out, which they often do in a bull market, we become more confident of our abilities. And this continues, in terms of making even bigger bets until you have a bad trade or a series of them. And then we have a major hit to our overall portfolio, and the effect is devastating. I mean, you lose confidence, you become more reluctant to buy, even when your system, whatever it is you're using, fundamentals or technicals, says that it's a high probability purchase. Even worse, the more you lose, the harder it is and the longer it takes to rebuild your portfolio's value. So here's step 3. What's the price of the stock that you want to buy? So let's say it's my favorite theoretical company, XYZ Widget, with a made-up $10 stock price. Step 4, what's my give-up price or my loss exit point? In other words, if the stock that I'm purchasing goes down instead of up, at what price do I say I'm wrong, sell, and take the loss and move on? I'm going to say, for the sake of my theoretical example, that if XYZ Widget falls 30% to $7, that's my give up or loss exit point. You might choose a smaller or larger percentage number. Or you can look at a chart for a recent support level and let that price become your give up point. Regardless, this is the hardest part of investing or trading, in my opinion, taking a loss. And everyone from Buffett on down is forced to do it at some point. Now, much depends on your trading style, what kind of instrument you're trading, options, futures, ETF, stocks, crypto, the volatility of that instrument, and how often you tend to trade it. But just remember, small losses, they're part of the game. But if you're forced to take a series of big losses or one big loss, it's more like game over. Step 5, figure your risk per share. You do that by subtracting your give up price, your loss exit price, from your stock purchase price. So my XYZ widget has a $10 stock price. My give up price is $7. So my risk per share is $3. Step 6, divide your risk per share number in step 5 into the dollar figure you came up with in step 2 and its percentage risk per trade. So in step 2, I determined that I was going to risk $100, 1% of my $10,000 portfolio. In step 5, I've already calculated that I have a risk per trade of $3. So you take that $100 divided by $3, and that means that you can buy 33 shares of XYZ widget. So since I've already said it has a $10 stock price, that means my total purchase would be $330. So the steps I'm describing here, they may not make intuitive sense at first. So write them down on a piece of paper. Work your way through each step. Pick a stock that you want to buy. Decide on a give up point below your buy price. And then use the math there to figure out how much you want to buy from there. If you stay at it, I believe it will help you to see the risk and reward in your portfolio in a whole new light. Now, I came up with this approach after years of research and struggling because I didn't really know what I was looking for. And the steps I've described here, it turned out, are very similar to what professional poker players use in Las Vegas. When they sense that the odds are good, that they're holding a strong hand, they bet more. When they feel like they have a weaker hand, they bet less. Big wins, small losses. If they have a series of losses, then they will progressively cut down how much money they risk per game until they start winning again. Now, once I started using these steps, it really just transformed my trading and investing. For one, I'm able to let my stock trades play out far longer. I'm not bailing out of a promising stock that I like because I'm overly nervous about a loss because the shares happen to be down a few percentage points. I know already what my loss is. Now, I still have occasional losses, of course, but my account balances recover more quickly because I'm not betting too much. I'm not betting so much at any one single trade if it goes south on me that it kills my account and ruins my confidence to make more trades in the future. Now, I recognize, of course, that this is not a one-size-fits-all approach. Now, some of you just don't like to ever sell a stock if you can help it, and you'll sit on a loss for a long time waiting for the turnaround if it comes. Others of you will sell at the slightest decline in price. And, there are risks and rewards, I guess, to both approaches. My point is that it's helpful to know what your risk is before you make the purchase. It's not a formula for magic beans. The steps do not mean that you won't pick losing stocks or, somehow magically sidestep a bear market or avoid, the kind of scary market collapse like we saw in the first months of the coronavirus pandemic. But the steps that I've described here merely provide you a concrete way to figure out a sizable portion of your risk in each trade. How aggressive or cautious you want to be, how much you want to trade, that's only a decision that you can make. It depends on your appetite for risk, your own trading style, financial goals, and the volatility of the instrument that you're trading or investing in, stocks, options, futures, crypto ETFs. For instance, options are highly volatile leverage bets. It's not uncommon to lose 50% or more on some contract trades, but that's usually interspersed by gains of hundreds or thousands of percentage points if you have a good system like we all have here. Likewise, with an obscure tech or biotech stock, a temporary bit of negative news could cause it to plunge 50%. But that may not be unusual volatility for a stock that could also rise 200 or 300% in a matter of weeks or months. And you have to accept the risk of one in order to get in line for the potential reward of the other. So to really learn how to invest successfully, you can read all about it all you want, but until you actually put your own money on the line, it's all literally just theory. By taking this approach, using the steps I've outlined here, it will help you to see risk, get a better sense of it, and also give yourself more time to develop the experience, knowledge, and confidence to achieve your financial goals. I'm Jeff Yasteen.